Okay, I see people are still joining us this morning, and today, but I do want to get started. Again, thank you everyone for joining us on this first alumni webinar. We're going to be doing these once a quarter at least. And so, first of all, let me introduce myself. It's Pamela Russos, and I recently joined the center, but I've been a mentor for 5 years. And I've worked with a few of you. I know some of you, and I look forward to meeting all of you. And so really we want to focus on continue to provide value to you. And so, like I said, this is our first webinar, and I would really appreciate any topics that you would like to hear about. Just feel free to email me. I think you should be seeing my screen, which has my contact details in terms of both email, or you can always tweet me at Pamela Russos as well. In addition to the webinar series, you'll be seeing an email from me soon announcing our online community. So we'll be launching that on February 24th. We will have an alpha and a beta version of this, and so if you're interested in participating in alpha and beta, please again let me know. The purpose of the community is to allow you, it's all virtual online, to have discussions with us, but then also among yourselves around relevant topics. Also be a place where you can post jobs, be a resource library for you for contact details for services that are available to you. For the most part, pro bono, but around legal services. I'm looking for accounting services as well. And then also like things like this webinar that is being recorded will be available there too. So again, you'll see emails from us coming out, but if you would like to participate in alpha or beta, just let me know. In terms of the logistics of the webinar, you are all in listen only mode. If you have any questions, just feel free to please just type them into the chat window, and we'll get to those. Anything that we don't get to here in the webinar, we can follow up through email as well. So with that, and as I'm turning over control, let's see, can I do this and both type and talk at the same time? It can be challenged that way. I'm going to turn the controls over to John. John Kohler was a mentor, and so some of you have worked with him in that capacity. He heads up now our Impact Capital group here at the center. And sorry, I can't type and talk at the same time. So John, I have made you presenter, and you might have to unmute yourself in order to be heard. John?
Okay, looks like the green bars are going. Hello, everyone, and looking forward to, I think I may need to mute my microphone too. Hold on. Okay, I think that still works. Therefore, no feedback. I think there will be a number of others still joining, but we've got a good crew. I'm very appreciative to reconnect with many of you by webinar. I think this is a great program that Pamela has set up, and we look forward to presenting important topics and or insights as we have them, mostly created or responsive to you all as GSBI alumni. So this is the first of hopefully many to come. Today's topic is on impact investing. Of course, impact investing has gone through quite a bit of change. It's a nascent field, if you will, only about a dozen years old, and I think that there will be several changes. I'm going to highlight a few of the changes that I see happening now, and maybe give you some predictions. I realize that it's difficult to be too specific because each of you have different business models. Some of you might be grant supported or PRI supported. Some of you might be looking or have investment capital to fuel your companies. And I would like to be responsive to each of you, so it's important that you do key into the chat window any questions you have as I go along, and then Pamela and I will aggregate those questions and be more specific. My goal is to leave about half the session available for questions that you might have. So please don't be shy. Go ahead and put your questions into the chat window that you see in the GoToWebinar control panel.
John?
Okay, so
John?
I will show you my screen now. Stand by, and some of these slides you will have seen before if you've been through our program recently. But let me see if we can come up. Okay, yes. Just trying to get the screen up. Thane, thank you. It looks like GoToWebinar is controlling everything. Pamela, can you chat back and see if this
Do you see?
You're able to see this slide?
Yeah, I'm not seeing anything, John. There is a button saying show my screen. Do you see that? Under screen sharing?
Okay, there we go. Finally got control. All right. So I'm hoping you can see this. Not sure why I was prevented for a while, but let's just go ahead and launch. You know, it's a funny sort of cycle of capital. I like to talk about it in terms of round trip of capital, and you'll see in the next slide what I mean by that. But I also try and coach many of the entrepreneurs who come through our center and those who will listen that you need to put yourself in the sort of the mindset of, or the experience set of your sources of funds, in addition to having your own perspective of your challenges and running a company. And this particular comic is, I think, is fun because from the mind eye of an investor, it seems like the entrepreneurs keep coming back for more money, just like this little kid is coming to his dad and saying, "Gee, can you give me more money for my next startup?" Entrepreneurs are infectious in their enthusiasm. They usually have bright ideas that people want to grab onto, but investors tend to be pretty careful because after not being careful, they realize that it is a much harder job, as you all recognize, to not only to raise money, but then to do something very meaningful with it and get to an exit that pays back the investors. And I think the first comment I would make is that the impact investing community as a whole continues to have difficulty realizing steady gain or a steady return of their investment through various exits or through management buyouts or other kinds of debt capitalization to pay off the investors, the original investors. So it remains a problem on this round trip of capital. And what I mean by round trip of capital, and many of you have probably already seen this slide, is that there are sources and directions of capital that go into SGBs, or what I call targets. And then the point is that it doesn't just stay in the target. The investment outcomes, usually financial outcomes, and sometimes reporting requirements and impact measures are asked for by the investor, and understanding not only the geography, mission, size of funding, and type of capital coming in from impact investors is important, but it's probably even more important to go back further and understand where does that capital actually originate. So it might not originate with the fund, such as Grassroots Business Fund, who might have given you funding or provided funding, but you need to look behind Grassroots Business Fund or other funds like them and say, where did their capital come from, and what are the mandates or the pressures that fund is under by virtue of having taken money from limited partners who contribute to any given fund like Grassroots Business Fund, which would have a different set of LPs than, say, Acumen Fund. So it's pretty important for entrepreneurs to go to school, so to speak, on their sources of capital to best understand the motivations and the expectations for return that capital has.
John.
So you see that is a round trip. This is my little let's make sure that we have round trips of capital. I also like to characterize this as a promise. One of the things that's real important, and I would ask all of you to think about pretty carefully when you are approaching sources of capital, is what is the promise that you can make to that investor or investor group? Holy smokes. So Pamela says my slides still are not showing. So I'm going to tag out of this and okay, so I'm wondering if that helps. So Pamela,
yes.
could you? Wait. Yes. Okay. So that worked. Sorry. You can tell we are learning how to do this as we go. So Pamela, please do text me again if there's any further problems. So I'm going to go back one slide. This was the round trip slide that I was just chatting about and talking about capital sources, directions of capital, target and investment outcomes, and the round trip of capital that I try to show. The promise that I'm talking about here is knowing not only what amount of capital you need to support your business plan, but what kind of capital you need. So the promise that you make, for example, with a loan that you might take, and that loan can be, for example, a program-related investment from a foundation, or it could be a factoring line of credit from somebody like Invested Development. You need to be making a promise on how that loan goes back. The same thesis is true for equity or other kinds of instruments, and that thesis is, are you able, in fact, to meet the promise of paying back that equity investment? And I think with equity, it becomes a little more problematic because it requires your shares in your company to be purchased by another investor at a later time at a higher price. And sometimes that's difficult to achieve, and I think we can have questions about that as we go along. In addition to that promise, I think, understand that you can make and deliver back, it's important to understand what is the impact intent that the source of money, and I list here macro investor, philanthropy, excuse me, impact investing, and then regular investors. This is actually something that was put together by Walsh, Lawson, and Lane Zucker in a book that they published. But it's a pretty good compendium of different forms of capital, and then they look at, is it an impact first or a financial first in their screening, and what is their impact intent. So putting a dot somewhere on this chart for the source of capital that you're talking to helps you understand how you might align, and in fact, the promise that you might need to make to these sources of capital as you solicit them. There was also a recent study done that we participated in by the World Economic Forum. Its focus was, can we in fact expand the field of impact investing, or the participants who could be potential investors for your social enterprise, to mainstream investors, and you see that highlighted in green in point number 3 here. And they are asset owners. The asset owners are different than fund managers. That's my point to who actually is the source of capital, and that's the asset owners. And sometimes the source of capital goes through a fund like Grassroots Business Fund, and they would be termed an asset manager. The same thing is true in more mainstream capital, and so the asset managers might be mutual funds. They don't actually own or aren't the source of capital. They get that from individual and institutional investors. And we're seeing that there is some appetite for these mainstream investors to come into the impact field. In fact, another form of impact investing or thread that's happening increasingly is that impact investors are beginning to look across all forms of assets. So not just direct investments in companies like yours, but also direct investments in a fixed instrument or land trusts or fund of funds, where they would put money into funds, then go out and find other local funds, or microfinance funds. And so they're looking across many different impact asset classes as ways to deploy their investment capital. And it's beginning to have a much more of a portfolio view. And in a few months, I think you'll see some developments from the Center for Science, Technology, and Society along that score. But it's important to note that that is an effort also to attract more mainstream capital to participate in the impact sector. And with that will, of course, come different expectations for that capital. So I would just ask that you, again, be students of this trend and start to understand the expectations of that capital. One of the World Economic Forum study components was we had done a review about a year ago of many of the mainstream fund managers and asset owners. These are money center banks, pension funds, insurance companies, high net worth individuals, and so on. And we said, you know, what's keeping you from coming into impact investing? And you all are very aware or are familiar with word clouds, and this is the word cloud that came out of that rather comprehensive survey. And I think it's instructive to any entrepreneur to look at this word cloud and say, all right, how do I try to overcome some of these barriers, so to speak, that keep capital from coming in? For example, immature measurement, or lack of transparency, or no track record of exits, or high cost of due diligence. You know, how can you make your diligence job less costly? You know, what are the other syndication partners that might be available? How do I avoid confusing rhetoric or hyperbole in describing my business? How do I get to just, you know, good business representation of my business model and my value proposition? So all of these are, I think, good leading questions for you to ask yourself as you approach different sources of capital. Now, the 4 do's of fundraising. Everybody says what not to do, and I wanted to concentrate on what to do. And this is, again, fairly general, but I think it's a truth or a set of truths applicable to everybody, whether you're raising grant capital in philanthropy or whether you're raising equity capital. The first is to tell the truth. From an investor's standpoint, when they're in their diligence process, you know, they first rely quite a bit on self-reported information by the entrepreneur, and that's great. They then have to go verify some of that information. They can't possibly verify all of the representations made in your pitch deck or in how you represent your business model and the investment opportunity. But if they find something that does not square up, it causes them to question everything else that you might have told them. So the most important thing here is, when you're talking about your business, tell the truth. The second is know your ask. This is something I was alluding to in an earlier slide, but certainly know what type of capital and the amount of capital is that you need to raise that fully supports your business plan. And I want to make another point here on knowing your ask, and that is that you also need to know what the full amount is that's required to fund your business model. And I've seen in many occasions in impact investing a problem where entrepreneurs will cash a check that a well-intentioned investor might write for them before raising the amount of money. Usually in venture capital, the right discipline would be to gather the checks into an escrow account, so that the entrepreneur or the company would establish an escrow account. Any money raised would go into that account until a sufficient amount has been raised that fully funds the business model, and then the close happens. Instead, many times, in many cases, you see impact entrepreneurs who are running around raising money and cashing each check as it comes in, never fully funding the business model. And I think that's a mistake, because you will always be in fundraising mode rather than execution mode, and your investors really shouldn't let you do that. The third point is to identify risks and have the solutions. You know, if you go back to that word cloud, what that word cloud really speaks to is building confidence. In other words, those items there were items that lead to a lack of confidence. And so your job as an entrepreneur and fundraiser for your company is to build confidence. Nothing builds confidence more quickly than an entrepreneur who says, you know, here are the risks in my business model, or here are some of the challenges in my environment, and here are the ways that I'm meeting those challenges, or that I've thought through a solution. And you know, if you vote with your checkbook with confidence towards me, this is the part of the use of proceeds in order to help us grow and overcome some of the challenges. That really helps the entrepreneur, or helps the investor understand and believe that the entrepreneur has thought through what their true business situation is, and are mature enough to accept that there are always going to be some risks and always have some challenges, and they're capable of managing that. The final piece, of course, is, as I mentioned earlier, is to be able to articulate that return. In other words, articulate what your promise is, how this money is going to come back, what the timing for that money coming back is, and what the impact measures. It's not just the money coming back, it's also, you know, the reason why impact investors are impact investors is they are going into organizations like yours because of your intentionality to create positive social and environmental impact. So describing both the impact measure and as a return and the financial return is pretty important in fundraising dues or practices. I'm not going to go through these next 3 slides, but many of you will remember this from a report that we put out in 2011 talking about coordinating impact capital. But I do think it's helpful to remind you all that there is a what I would call a fish ladder. These are the different pools that are constructed for fish to swim upstream, and they jump from one pool to the next. And in that same way, or using that same metaphor, you know, entrepreneurs or very early stage companies can jump from one pool to the next as they become more mature. And there are milestones that I think are helpful to keep in mind as you think through your next round of capital. And the point that I want to make here is, you know, and I'll flip through these 3 slides, but hopefully Pamela can send a copy of this particular presentation to you after we end this webinar. What's important to understand or keep in mind is what are the true requirements of where I might come or might receive capital the next time I go out to seek capital. Maybe there isn't a next time. Maybe it's an opportunistic growth related stage. But regardless of how you might have your capitalization plan laid out, there's probably another funding event somewhere in your future, whether it's debt or loan or factoring or growth equity. There's probably a funding event, and knowing how to pre-position yourself and your company and your business model and what to bolt into that business model and your weekly or monthly practices is very crucial to the success or failure that you would have as you approach other forms of impact capital and impact investing. So these are simply saying, you know, what do you do moving from grant capital to program-related investing, or what we would call soft loans? What do you do for moving soft loans to equity, and what do you do for moving equity or quasi-equity into equity? So let me pause there. I'm going to check on questions. I don't see any questions yet. Hopefully Pamela is
John, can you hear me?
But again, please write in your questions if you have them. I'm now going to switch to talking about alternative investments, because one of the other developments that I'm seeing in the impact investment space is on alternative impact investing, alternative vehicles, and these are what I would otherwise call structured exits. So it is similar in its form or reward as equity might be for an impact investor, but it takes the form of debt. And I want to go through some examples and talk about the pros and cons of this new form of investment vehicle called structured exits. So the genesis of structured investment vehicles for impact investors really came about because of the inability to find liquidity through equity investments. And equity liquidity often meant one of two things, actually one of three things. One would be an IPO, which rarely has happened. And whenever I walk around and talk to some impact investing colleagues, they say, okay, my question would be, okay, tell me what the best, what is the best IPO that's happened in impact investing? And invariably, those who could answer will say Comportamos in Mexico. And Comportamos was no doubt a great success from an IPO standpoint, but it was also an IPO of essentially a microfinance organization. So, well, that doesn't really count. That's in the microfinance field, not in the social enterprise investing field. So the answer really is there's been very few. And so IPOs are not a good way of counting on an exit for an equity impact investing theme. And so you say, well, then one of two things has to happen. Either the entrepreneur has to sell their company to another company, and those shares are then bought out, and the investors and the entrepreneurs can receive some money for their investment, or they have to go to a bank and take enough of a loan out at a bank based on their business model to pay back the equity investors or essentially buy out the shares. This is true, for example, when we speak to Acumen Fund, oftentimes their exits have been through this sort of management buyout or leveraged buyout of their equity position. Neither one of those, either selling the company or the management, saddling the company with a significant amount of debt in order to pay off the equity investors, is very desirable. And so the need for structured exit has risen because traditional debt doesn't carry enough risk premium to justify its use, and consequently it's very difficult for many social enterprises to actually go out to a local bank and to obtain debt. I'm sure you all have some of that experience. So the idea of having a form of debt, or you might even use a venture capital term and call it venture debt, that has a sweeter or higher payout or risk premium has arisen, and there are several forms of that. The nice thing about it, this non-equity instrument, is that it helps return capital in a better or a smaller amount of time, such as 3 to 5 years. It also helps overcome some imperfect market conditions where IPOs aren't available or not possible because of either poor economics or poor reporting that come out of those economies. And it, I think, has an increased likelihood of a positive outcome or positive return to the investor. And that's pretty important. And just as important to the entrepreneur is it avoids the need for the entrepreneur to have to consider selling their company, which is in many cases not why entrepreneurs start their companies. They start their companies to actually continue to run them in perpetuity. So let me speak about a couple of different structures. The first is royalty or revenue participation structure, and I'll give you an example of that in a moment. And the second is a demand dividend. And the demand dividend is actually one that if you come to our Santa Clara website, you can go to the impact investing portion of the center's website on scu.edu/social benefit. If you go to the impact investing page that you can click through from our main page, you will find a place that you can look at not only a concept note about the demand dividend, but you'll also find a link to a self-generating term sheet that when you fill out several questions that give the boundary conditions, allow you to produce at least a term sheet that can act as a starting point for the promise that you would want to make to sources of capital if you in fact choose to use structured exit mechanisms. The revenue or royalty structure is different than a demand dividend in that it is a structured debt that is paid principal and interest each month, whereas the demand dividend is paid out of a definition of free cash flow. So you only pay it when you have cash available to pay that debt, and that if you aren't able to satisfy an interest payment or the pay down of the principal, it rolls to the next quarterly calculation without penalty. That's the demand dividend. The royalty or revenue participation scheme is a periodic debt repayment, but it has sweeteners that are tied to either a royalty on net income or a revenue participation, which is essentially a carve out of your top line revenue as a way of sweetening the return to the investors who are utilizing this instrument. You can see here that along this slide, which I won't read, you can read it for yourself, but that there are several sliders and knobs that the fund or investor that uses this as an origination tool for an investment can use, which is to change the interest rate. They can change the term. They can define especially in the case of the demand dividend, they can define what the total payment multiple will equal in terms of what multiple of the original investment amount is paid off in total. In the case of revenue or royalty participation structures, I've also seen some equity being purchased. And so an example that I can show you is here, where in this example, $200,000 are being is being invested, and part of the $200,000, in this case $10,000, goes into purchasing some shares of the company with a hard-coded or a mandate that the company, after 5 years or at the end of the term of this financing, has to buy back those shares at 3 times the cost. So essentially 3 times the $10,000 that was put into equity. So there you see a multiple, at least on the $10,000 portion. And the residual amount, or $190,000, goes into the company bounded by a 5-year term and a 5% interest. In addition to that, the company has an obligation to pay 1% of its, as a royalty, of its projected sales. That's either the actual sales, as I said in the last slide, or its projected sales. So we can look to the bottom of this slide and say, well, you can see that at the start, there's $200,000 going in. There is a stipulation on this loan that only interest is due and not principal in year 1. So, and sales, projected sales in year 1 is $320,000. The actual sales was 0 in this example. So, oops, the entrepreneur missed their projection because they didn't bring their product to market in enough time to have any sales. And so the royalty payment is on the projected sales, not the actual sales. And the total payments were in year 1, the interest on the loan only, and 1% of the projected sales, for a total of $12,700 on the total cash flow back to the investor. And then you can follow in year 2, where now over the next 4 years, starting on year 2, 1/4 of the $190,000 principal gets paid off, in addition to the previous year's or that year's accrued interest, which as they pay off the principal in the beginning of the year, the amount of interest that accrues is less because the outstanding principal is also less. And so you see those interest on loan payments in year 2, 3, and 4 going down. You then drop down for the sweetener part, which is the 1% of sales, and you see that projected sales in year 2 was $640,000. Actual sales was still less, but at least they brought the product to market. And so the 1% is paid on the original forecast. And then you see in year 3 that those numbers equal, and in year 4 the example shows that actual sales, suddenly were much higher than the original projection. And so now the 1% applies to actual sales. This example is taken from another piece of work by someone else in the impact industry, and I think is based on an actual case. But the IRR, or the total return, when you look at not only the principal and the interest rate payment and the 1% on projected or actual sales, and then finally in year 5, the $30,000 that comes back from the equity repurchase, yields about a 17 or 18% IRR, depending on how you want to calculate the timing. So it's a nice risk premium for an impact investor, and could be a pretty useful tool for you all. Some of the advantages is, as I said earlier, it avoids the dilutive effect of ownership from an early equity raise. It also, I think, helps this exit because it's much simpler. You don't have to argue over what the valuation of your company is with the investor coming in, and usually that's a difficult discussion because valuations are more conceptual than they are based on actual cash flow or discounted net present value to where you think you'll have your company after the investment, sort of operational achievements you'll have 3 or 5 years hence. It's also easier for you to base some financing on projected cash flows. If money comes in, what do you think that you'll do with your projections? And I would, if you were all in front of me right now, I would ask you all what you think the disadvantages are. I'll simply answer my own question and say that the disadvantages to structured exits are that it might not allow for as much financing up front as you might want, because it's based on your ability to service that with your cash flow or your revenue. It does not apply to companies that are still in early R&D because they're too far away from cash flow to be able to take money in 1 year and begin paying it off in year 2, 3, and 4. It might have some different tax treatments that are more expensive for the investor, so that has to be looked at, especially as you localize these instruments for your own country of where you exist. And then the limited term on the instrument also implies a redemption right. And I don't know how many of you have done an equity term sheet but in the past, but you'll know that there's a clause in there which is a redemption right, which means that the investors can, in fact, demand that the money comes back after the end of the term. And certainly you'll see if you go and play around with our demand dividend self-generating term sheet, there is an ability by the investors to say, okay, if you've not met all of the payments that are provided for in the financing, that the investor can ask for, or have a redemption clause in there that says, give me the money back. And that could be an issue if you're not in ability or not in a position to pay that out. So then the negotiation starts to say how you might extend or replace the structured investment with a new one that pays off the old one and then helps you carry forward. So a lot of information there on structured exits. Again, I always like to show this slide because I love this car. But again, put yourself in the mind's eye of the investor. They really are your partner. And just like any partner, you need to tell them the good, the bad, and the ugly, and let them be your partner and help you with their capital, and you help drive it forward with your operational excellence. One final word about governance. I always like to point out that some of the worst term sheets that I've seen in impact investing have been from impact investors. You wouldn't expect that was true because impact investors are there because they just love the inspiration of your value proposition. They love the impact, the positive social and environmental impact that you're delivering. But the reason why some of these term sheets are so, in my opinion, ugly is because many impact investors are very remote from where you are. And so they try to control through protective provisions and control provisions and what are called consent rights. They try to control your behavior. And to me, it is a form of bad governance. It does not allow the normal functioning of a company where managers or the entrepreneur who's running the company is free to make the decisions that are the day-to-day decisions And then where there are important decisions, such as committing the company to a new office lease or to a large asset or capital equipment purchase, or hiring, a significant new player, those kinds of decisions are done in conjunction with board governance, and that the investor governance only happens after the board governance, or even outside of the board governance structures, and should not take the place of either the day-to-day management control, nor should it take the place of the month-to-month board governance structure. So you've got to really take a look at that and speak to the investors who might be motivated to try and protect their economic interests, but do so unwittingly in a way that restricts your ability to manage the company. And that's, just an honest, self-effacing kind of conversation that you need to have when you do take in new capital, especially if it's on either an equity purchase or if it's on a structured exit purchase, because they have similar rights or privileges. In terms of the protective provisions, or what I would consider effective or reasonable, either equity or structured exit economic protections, I've listed them here in general, and they're all pretty normal. I mean, it's, they get a vote, your investors get a vote on whether or not you decide to sell your company. They get a vote on whether or not you decide to increase or decrease the number of shares in your company. They get a vote, of course, if you change or doing something in your corporate structure that might change their economics or their privileges. They get a vote in terms of number of board seats. They get a vote on, taking on new debt obligations that might impair your ability to pay them back, and so on. So I think that those are normal. When they go beyond, and I was just coaching one of your colleagues that had come through GSBI several months ago, who received a term sheet. I won't say whom or where, but it was in Africa, and they received a term sheet from a European-based investor, and that term sheet had 27 consent rights. That, I think, is overreaching. So these that I list here, which are about 9 or 10, are good and normal and understandable. But when it gets to a list like 27 or 30 consent rights, then I think it's overreaching, and they're trying to take too much control in your company. All right, with that, I will stop, because I promised time for questions, and Pamela said that there are questions. And Pamela, I don't know how you want to ask, but when I turn my question caret, nothing shows. So I think that you're going to have to text me.
Can you hear me?
Or chat to me questions that you've received.
Can you hear me, John? Hold on.
Okay, I'm waiting for some kind of chat. Here we go. I can't hear you. So now go ahead and try.
Can you hear me?
There we go. All right, excellent.
Okay, thank you. Okay.
I get feedback, which is why I turned my sound off.
Okay, so a few questions. One that Thane had was, how does the escrow concept that you talked about earlier work with for the alumni that are raising grant capital?
Yeah. So in the case of grant capital, it's a great question. It is not exactly the same. You are still, when you're taking in grant capital, you are pledging a set of obligations, meaning that you're obligating your enterprise to perform against the stipulations in that grant. And then when you receive the grant, you need to agree with your grantor that in fact you can deliver either the beneficial outcomes or the impact that they're looking for. It could be job measures, it could be creation of opportunities to underserved populations like handicapped people or women or otherwise, farmer communities. So when it could be hectares that come under irrigable development. So whatever that is that that you're receiving the money for, you need to make sure that in fact you can deliver. One example is one of your colleagues that came through GSBI and is in India received an investment that was staged over a 3-year period, like grants usually are. But when you looked at the stipulations of the grant, they were having to open more energy centers in each of the successive years, and they were receiving less money to do so in each year. And so, clearly they needed to flag that and say, well, wait a minute, I can't have 50%. I can't have 8 centers, for example, in year 1, and have to do 16 centers in year 2, but have less capital than the 8 took me in year 2. So you do need to align your business operation to that. Okay.
So, John, there are several questions that are kind of all revolving around, as you talked about. There's the entrepreneurs really need to have a partnership with their investors. So there's questions around how to identify the right investor, and then you were talking earlier about telling the truth, and so there's some concern about how much truth and what can I really tell, and or before they run away, and so if you can talk a lot around that whole idea of partnership between the SEs, from, like I said, and their investors, from identification to starting the dating process before they get married.
Yeah. No. So excellent set of questions. This is going to sound a little bit harsh, but I want to point out the responsibility of entrepreneurs. There's also equal or more responsibility by impact investors, but entrepreneurs in the social impact sector have a great responsibility to make sure that we don't how would I put this, turn impact investing and social enterprise into a fad. And the way that it would become a fad is the same way that other technologies that have been brought to market or brought in front of the venture capital industry have become fads, and that is that it's overhyped and underdelivered. And that would be a tragedy, in my opinion, for the theory of change that we're all operating under, which is we can use business and market building mechanisms to build prosperity and create social and environmental change in underserved communities around the world. If we oversell that and then underdeliver, the investment appetite will disappear. And the follow-on social entrepreneurs like yourselves, I mean, the people who are coming behind you, will have no opportunity to fund their companies. And that's being a little harsh, but I think it's what I'm trying to point out is I don't think that there's a substitute for being honest about the situation. Now, how much is there? I think you can acknowledge it. You don't have to get into gory detail unless you're asked, but you need to acknowledge where the challenges in the business model are. You need to acknowledge and be forthright about, here are the ratios of my financial performance that I think I need to work on. Here is a distribution plan that I think works today, but really isn't allowing us to grow as strongly as we could grow. And so I think you get the point that I'm making, which is if you aren't forthright and then later the investor loses their money because there really was a fatal flaw that you failed to disclose in the business model, you might have received money for a little while, but that investor is going to go away unhappy. Your ability to raise additional capital is going to go away because people will know that there's an unhappy investor out there. And more importantly, I think if that happens collectively, then the impact investing space will come to a point where investors say, oh yeah, I've been there, done that, lost my money, I'm going somewhere else with my investment capital. Really important. In terms of finding the right minded or a partner, because it truly is a partnership, you want to have investors, and I was just having this conversation last night at a different salon that Thane and I were at, but you want to find investors that understand the value proposition that you're bringing to market and can help you do that, that understand how they can contribute. And that could be helping you identify new executives that you can hire, helping you line up sources of supply or channels of distribution for your products or services that you're engendering, help you with some of the tougher parts of your financial or finding debt financing in addition to equity financing. So you want to find people who understand your business. First of all, they don't have to be living right next to you. They can be a continent away. But if they've made similar investments, then you know in a similar or the same sector, then you know that they at least have some experience there. The second thing that I would say about finding that alignment is if you go back to that puzzle slide, look at the direction of capital and ask those questions. There are investors that limit themselves by what geographies they play in. They limit themselves by what sector or impact theme they want to support. They limit themselves by the size of investment. Either they won't go below $1 million or they won't go above $50,000 or something in between. And then they limit themselves or try to restrict themselves by the kind of capital. They're only debt sources, or they only invest equity, or they only do PRIs or MRIs. So look at those boundary conditions to help you figure out, are you aligned with your promise to the kind of capital and the direction of capital that a particular potential investor usually likes to agree to. Okay, Pamela.
So on those nasty term sheets that you talked about, John, that you've seen, so how can our alumni have that discussion with these investors? That difficult discussion to say, no, this isn't good, especially as an SE. I need the money, and so how do they have that discussion effectively?
Well, so great question. I think if you start with there are some examples that you could start with. What I mean by examples is that you can pull out other term sheets. And in fact, you can generate a demand dividend term sheet off of our website and use some of the control provisions that are in there. Or you can use the two slides that I appended to the back of this presentation as a starting point and simply put that on the table and say, I want to make sure there's a balance of governance here that helps the company operate as efficiently as possible. And let's talk about the decisions that management needs to be able to make on a day-to-day and week-to-week basis, and that the board should help guide management with on a monthly or quarterly or provisions that the investors, regardless of their board position and regardless of their ownership position in the company, have a right to make because they want to protect their economic interests and not have those unwittingly given away. And I think that that's the sort of the three-step or three areas of company operation control that you can start with. And it doesn't have to be a contentious discussion. It can simply be, as you're forming term sheets, you can have that discussion up front. Because really, if the investor is smart, yes, they want to protect their economic interests, and you certainly want to make that pledge to them. But if they're smart, they want you to operate as efficiently as possible. They don't want you to have to run to them for every minute decision, which I have seen, because the consent rights said so. I don't know if that helped, but that's certainly the place I would start.
Yes, thank you, John. And I just sent the URL to the Impact Capital section of our website to everybody, but I will include it in the slides. And so we're coming to the end of our hour. So for some of the questions that we still haven't gotten to, we can certainly, I'll follow up with you on email. And
Okay.
we will provide the slides. I'll create a PDF. And like I said, we've recorded this session as well. So we'll be making both of those assets available to you. Again, thank you so much, John. Thank you so much for your time. Thank you, everyone. Again, if you have some topics that you are wondering about, please feel free to email me, and it's just prussos at scu.edu. And all of you should have my email address from emails and such already. I know that governance has been is a hot topic, and so I'm looking at having the next one or maybe several webinars around governance, but if there's some other topics, please let me know. And again, you'll see emails. We'll be launching the portal by the end of February, February 24th. And so these kinds of assets will be on there, as well as being able to ask these kinds of questions and also share among yourselves around learnings and good term sheets and investors that have been great partners, and all of these kinds of things can be discussion points on the portal.
Yeah, in fact, that kind of best practice and best partner sharing could be enormously beneficial on a region by region basis.
Right, right. Good. Any last words, John?
No, just again, I'm thrilled to be able to do this. I hope I get to do it again if Pamela invites me back. And I think having a steady forum like this for all the GSBI graduates is great. So again, good luck to all of you. My last slide here, if I were to show my last slide, I don't know if you can still see it, but we're all inspired by your great work. You know, it's what fuels us to do what we do. And we're hopeful we can continue to add value to your great endeavor. So thank you for all the good hard work that all of you as entrepreneurs are doing.
Great. Well, thanks, John, again, and thank you all for attending, and we look forward to seeing you in the next webinar. Thank you. Bye-bye.